In this video, we'll be covering the BRRRR method and how you can use it to grow your real estate portfolio. Hey, what's up? I'm Mark Bellini, and I'm all about achieving financial independence through real estate investing and online business. So if you're new to the channel and you're looking to achieve financial freedom for yourself, be sure to hit that like and subscribe button down below. It really helps me out, and I'll be sure to keep cranking out these videos. So if you haven't heard of the BRRRR method, it is a strategy that real estate investors use to grow their real estate portfolio a little bit easier. And BRRRR is basically a shorthand, and it's a B with 4 R's. And what it stands for is buy, rehab, rent, refinance, repeat. And I'll kind of go through each of these so you can get an idea of how the method works. So the first one is to buy. And you need to buy a specific kind of property. You don't just go out and buy any property. You need to look for something specific. And in this case, you want to look for properties that are distressed. So, ones that have, drywall damage, or, they maybe have a leak, or there's mold, or just really, really dated. It's, from the 60s or 70s or older, and it hasn't been updated, and just really old smelly carpets, and just not in great shape. It's basically the maintenance has been deferred by the previous owner, and it just needs some love, basically. And what you want to do is buy a property like that below market value. So let's say there's a house next door that's been fixed up. It's really nice, modernized, and it's selling for about $500K. Maybe this one's selling for like $375 or $400 because it's so old and dated or has issues. So those are properties you want to look for. When you're actually buying these properties, there's different ways to purchase them as well. So you're going to go traditional financing, 25% down as an investment property. And sometimes if there is damage to the property, like, holes in the drywall, or, piping issues and things like that, you actually can't get traditional financing. So you have to go non-traditional routes. You might have to do like a hard money loan or a private money loan or something like that to basically, or your own money if you have saved up enough to go out and purchase this property, basically all cash, and then kind of start from there. But there's different ways to buy it, and so do what works best for you, and then we'll move on to the next step here, which is to rehab. And so basically after you purchase, you need to rehab the property. You need to bring it up to, modern standard of living. And when I mean rehab, you don't make it like the top of the line best rehab that you can do with marble, or granite countertops and all stainless steel appliances and, really fancy hardwood floors. And like, you don't want to do all that, because you're not really going to get your money back. You want to do basically like really nice rental grade quality. So like when a renter comes in, like, oh, this is a nice place. It has, luxury vinyl planking and some nice appliances that aren't overpriced, and just, a nice place to live, basically. And so you go in and basically rehab the entire property. And for that, you can use your own money, or you can use a hard money loan. There's different ways to go about it, but you need a budget for that. And what you do after that, after the property has been all fixed up, then the third step is to rent it. And so you find a renter. And since the place is all fixed up and really nice, you can have the rents be pretty high because it's all been modernized and it's really nice, and it, demands a higher value for the rent. So get a renter in there, get a lease signed, and then at that point, the fourth step here is you can go to the bank, and you go to a bank that can do a refinance for you. And what you're going to do is you're going to refinance the property and try and do a cash out refinance. And why you want to do this is because when you refinance the property and pull your money out, you can get your money out that you put in originally. So I'll kind of go through an example here. So let's say there's a property that you purchase, and you talk to a realtor, and they say, if this house was really fixed up and really nice, you could probably sell it for $500,000. And it's like, okay. So what you want to do is multiply the after repair value, which is ARV, multiply that by 0.75. And that gives you $375,000. So what you want to do, which is ideal, is have your all-in cost equal $375,000. That's the purchase of the property and the rehab. So let's say you bought the property for $300,000 and you did a $75,000 rehab on the property. You're all in $375,000. So when you go to the bank, you can say, look, here's this property, it's worth $500,000, and then, you know, you're all in for 375. So basically at that point, the bank's gonna be like, oh, this is really nice. And so they'll let you do a cash out refinancing and pull out that extra equity, that forced equity from all the upgrades that you did, pull the money out, and then you can just basically stick that in your pocket for your next deal. And that's where the next step comes up here. The fifth step is repeat. So what's so powerful about this strategy is you're just recycling your money over and over and over again. So you just like go out, find a property, rehab it, rent it, refinance it, pull your money out, and then go do it again. And the thing is with this strategy is sometimes you might get more than the original amount you put in. So that just, you know, basically more money that you get. Sometimes it's a little bit less, but the thing is, let's say you put in 125K and you were able to get $125,000 out. That's great. You know, you can just go do it again. But if you get, let's say you get $100,000 out, it's less than you put into the deal. You know, it's a lot easier to save $25,000 than $125,000 all over again. So you can basically get to your next property a lot faster than having to save up an entire down payment to go buy another property, because that really slows things down. So with this strategy, you can speed things up and grow your portfolio a lot faster. So that's what's so powerful about this strategy is you can scale your real estate portfolio a lot faster than you could otherwise by just recycling your down payment money basically over and over and over again. So if you like this content, be sure to like and subscribe, and I'll see you in the next video.